blockchain integration of U.S. GDP data and its implications for international finance, the global economy, and cryptocurrencies. The decision by the United States Department of Commerce to publish official gross domestic product, GDP, figures on multiple public blockchains represents a historic policy shift with wide-ranging implications for international finance, the global economy, and the rapidly evolving cryptocurrency sector. By placing Q2 2025 GDP data directly on Bitcoin, Ethereum, Solana, and 6 other blockchains with the support of major exchanges such as Coinbase, Gemini, and Kraken, the United States has become the first country to officially integrate sovereign economic data into decentralized networks. This move transcends symbolic adoption and signals a structural rethinking of financial data infrastructure, transparency, and market dynamics. From a policy standpoint, the development raises critical considerations for financial governance, market stability, and international economic competition. In the context of international finance, the move represents a paradigm shift in how markets access and process sovereign economic data. Traditionally, GDP statistics and other macroeconomic indicators are released via centralized government websites and distribution channels, often subject to time lags, data gatekeeping, and, in some countries, potential manipulation. By contrast, blockchain publication provides an immutable, globally accessible, and tamper-proof record of economic performance. This development has immediate consequences for global capital markets. Investors across borders will now have real-time access to U.S. GDP data, reducing information asymmetry and enhancing trust in American statistics. Such transparency could lead to more efficient pricing of U.S. assets, but it may also increase the volatility of cross-border capital flows. Central banks, sovereign wealth funds, and global institutional investors will need to adjust their forecasting models to account for faster and more widely distributed data dissemination. In the longer term, this precedent may pressure other countries to follow suit, or risk losing credibility in the eyes of international investors. The implications for the international economy extend beyond market efficiency. The U.S. economy is a cornerstone of global demand, trade, and investment. By ensuring that GDP data is not only published but also verified on multiple blockchains, Washington is exporting a model of transparency that could alter global trade relations. Multinational corporations, exporters, and importers worldwide will now be able to calibrate their strategies more precisely based on verified U.S. economic conditions. Emerging markets that depend heavily on U.S. demand or investment may experience sharper cycles of capital inflows and outflows, given that markets will respond more quickly to official data releases. While this enhances market discipline, it also raises the risk of heightened financial volatility in economies with weaker institutional frameworks. Furthermore, the geopolitical dimension cannot be overlooked. The move positions the United States as a global leader in financial digitalization, potentially compelling rivals such as China and the European Union to accelerate blockchain integration within their economic governance frameworks. This dynamic may contribute to a new era of techno-financial competition where credibility and transparency of data dissemination become strategic assets. Within the U.S. domestic economy, the policy also carries significant implications. Publishing GDP data on-chain aligns with the Trump administration's broader push to integrate blockchain and cryptocurrencies into mainstream financial infrastructure. The decision signals to domestic and international stakeholders that blockchain is no longer merely an experimental technology or speculative asset environment, but rather a tool of national economic governance. This is likely to increase confidence in U.S. official statistics at a time when data reliability has been challenged globally. Domestically, it could also deepen investor participation in blockchain-based systems, fostering innovation in fintech and data analytics. The initial market response underscores this momentum. Projects such as Pyth saw gains of nearly 70%. Chainlink's valuation rose by $1.80 billion, and Bitcoin prices edged above $113,000. These reactions suggest that the market perceives blockchain integration of sovereign data as both a validation of the technology and a potential foundation for new digital finance infrastructure. The world economy will likely experience cascading effects from this precedent. By setting the standard for publishing official macroeconomic indicators on decentralized networks, The US may inspire international organizations such as the International Monetary Fund, World Bank, and OECD to explore blockchain-based dissemination of global economic data. This development could usher in a new phase of financial globalization, one in which the integrity, transparency, and speed of data flows become central to global market functioning. Just as the Internet transformed financial communication in the 1990s, blockchain-based dissemination may underpin financial globalization 2.0, characterized by decentralized trust and real-time access to critical information. However, policymakers must be alert to the risks that accompany these benefits. Faster data distribution can amplify global market overreactions, increasing the potential for systemic shocks. For example, an unexpected negative US GDP figure instantly visible across the globe could trigger immediate sell-offs in multiple asset classes, potentially spreading financial stress to emerging markets. The challenge for global regulators will be to design safeguards that preserve the benefits of transparency without allowing real-time volatility to spiral into systemic instability. The cryptocurrency market stands as one of the most direct beneficiaries of this policy. For years, blockchain oracles and decentralized data providers such as Chainlink and Pyth have sought to establish themselves as bridges between traditional finance and decentralized ecosystems. The incorporation of official US government data legitimizes their role and may accelerate adoption of their platforms by both institutional and retail investors. This could mark the birth of a new asset class centered around official data tokens, where verified government statistics become blockchain-native commodities that can be integrated into decentralized finance, DeFi applications. Institutional adoption of blockchain data feeds may follow, as hedge funds, banks, and asset managers seek to leverage verified real-time statistics in their trading algorithms. Bitcoin's role as a global asset may also deepen. Beyond its function as a store of value, the integration of GDP data onto the Bitcoin blockchain imbues it with symbolic significance as a global infrastructure layer for economic governance. The crossing of the $113,000 threshold demonstrates market recognition of this symbolic evolution. From a policy perspective, the US move presents a dual narrative. It enhances transparency and trust in economic governance while simultaneously accelerating the integration of cryptocurrencies into mainstream finance. Policymakers must weigh the benefits of innovation against the risks of instability. Internationally, coordination will be required to prevent fragmentation in data dissemination standards, as competing powers may seek to develop their own blockchain protocols. Domestically, regulators will need to ensure that speculative surges in crypto assets do not undermine financial stability or expose retail investors to excessive risks. More broadly, there is a need to articulate a coherent strategy for blockchain-based governance that balances transparency, innovation, and stability. The integration of GDP data is only a first step. Future expansions could include inflation statistics, employment data, or even fiscal accounts. Each expansion will bring new opportunities and risks for global finance. In conclusion, the publication of US GDP data on 9 blockchains is not simply a technological experiment, but a policy innovation with profound implications for international finance, the global economy, and cryptocurrency markets. It sets a new global standard for transparency, enhances the role of blockchain as financial infrastructure, and signals the deepening integration of decentralized technologies into the architecture of economic governance. While markets have reacted positively, the long-term challenge for policymakers lies in managing the balance between innovation and stability. If managed effectively, this decision could mark the beginning of a new era of blockchain-driven financial globalization, where trust and transparency serve as the cornerstones of economic interdependence. If mismanaged, however, it risks amplifying volatility and systemic risk in an already fragile global financial system. Either way, the precedent has been set, and the world is now entering uncharted territory in the intersection of sovereign governance, global finance, and decentralized technology.